Ladies and gentlemen, boys and girls, children 18 plus, you are tuned into the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
D.O.
How are you today, sir?
Great. How are you?
Fantastic. I wore my Easter shirt.
You did?
For all of you Easter followers.
Yes? Looks good.
Yes, it's my spring shirt.
Festive.
Yeah, it's still a little bit baggy.
A little bit baggy. Gotta take that in.
So I just took in like 5 jackets and 4 shirts to the dry cleaner, who also does alterations.
Correct.
Stood like this with my arms out for like an hour straight.
T-pose.
T-post. Yeah. For anyone listening in on Spotify or on Apple Podcast, I'm sticking my arms straight out. My shoulders were screaming, but it's what happens when you lose 30 or 40 pounds.
Right.
And, I was reluctant for so many months to go spend the money to have the alterations done because I'm like, well, what if this was just a fad? What if this lifestyle that I created after going through 75 hard was just a fad? But we're going on 2 years now.
Right.
I'm like,
I think it's going to stay.
Yeah, I think it's going to stay. So, so this shirt still needs to go through.
Yeah, right. I know. It's a little
it's a little bit baggy. Whatever. It's pretty, right?
It looks good.
It's bright. Hopefully it pops on the screen. If you're tuned in on YouTube right now, it pops. Yep. Although it makes my face probably look that much rosy, but
You're fine.
What you going to do? Hey, because a question for you, and this question is going to lead right into today's episode.
Perfect.
What do you think the housing market is like right now for home buyers?
Difficult. Multiple offers on the same home.
Yeah.
Struggle.
Like coast to coast.
Yep.
I'm talking I was talking to a buddy of mine who owns a home in Newton, Iowa.
Newton, Iowa.
Yeah. Have you ever been to Newton, Iowa?
I haven't.
Maytag started in Newton, Iowa.
There you go.
Okay. So 60, 70 years ago, it was a town built around Maytag. It's about an hour outside of, I'm almost positive, Des Moines.
Okay.
Anyhow, he was talking about how homes in Newton, Iowa are getting multiple offers, how they're flying off of the market.
What?
Yeah. So when I say coast to coast, I'm like coast to coast, including Newton, Iowa, right? Homes are, there are more buyers than there are homes to sell. We talk about this often on this podcast. Mm-hmm. And at the end of the day, it has everything to do with a lack of supply to keep up with the demand. Mm-hmm. It's not like it was 15 years ago where there's this crazy inflated demand and there's also a crazy amount of supply. And then one day when the demand just diminished, the supply was still there and everyone said, oh, crap. And then that was a bubble and the bubble burst. Gotcha. Nope, this is one in which if we look historically at what the national home builders are building, how many units they're building, we're several 100,000 units short year after year after year. We rely on home builders to create new units to keep up with the demand. Mm-hmm. So with the home builders not building enough, then it takes the other homes that are on the market and it makes them more desirable just because of the whole supply and demand ratio. So so if you're trying to buy a house right now, it is no secret it is very, very difficult. There are multiple offers. Many times you're going to have to bid higher than the offer, possibly pay more than appraised value in order to win the bid, in order to buy that house.
Makes sense.
So let's do an episode from a lender standpoint, but also a home buyer standpoint, maybe even a seller standpoint, and even a realtor standpoint. What are some things that we can be doing in today's market to have our offer stand out?
Yeah.
And possibly, I want to touch on a subject of things that we can do to keep a transaction together, meaning keep the seller motivated to sell, the buyer motivated to buy, if and when the home appraises low, because we're seeing quite a bit of low appraisals because of this whole supply and demand ratio. People are willing to pay more than a home is worth because they really want a home. And when the home doesn't appraise, how can we keep that transaction together? That may very well lead me to the creation of another episode where I'll have to enact one of my mortgage insurance partners to come in and maybe be the guest, and they could dig deeper onto that subject.
Yeah.
But first and foremost, any questions before I get started on your end?
Yeah. When's the last time it's been like this where there's a shortage, where it's been like in this type of climate?
Well, scarily enough, 2006.
Okay.
In my memory.
Okay.
In my memory, 2006 was equally as not fun to be a home buyer.
Okay.
But comparing the two, in 2006, there were droves of speculative home buyers, but people who thought of themselves as real estate investors because financing was easy, and they were able to go out and obtain 100% financing loans on investment properties they never intended to occupy themselves, nor maybe even rent out. All they were trying to do is put a contract on a home, buy it, and 9 months later flip it for a big fat profit.
Yeah.
Okay, and there was financing readily available with no money down, financing readily available for people with poor credit, people who couldn't improve their income, et cetera, et cetera. That doesn't exist these days. In fact, we just did an episode last week where we talked about Fannie Mae basically making the obtaining mortgages for investment properties more difficult by increasing their pricing through a loan level pricing adjustment, all because they're trying to limit their scope of how many mortgages do they back to 7% or less that are second home or investment property, right? We did that episode, which, by the way, if you didn't get a chance to check out that episode, check it out.
Yeah, check it.
Like, it's on YouTube, it's on Spotify, it's on Apple. Like, we house all of our stuff there. Yeah. John puts up really funny clips on places like Instagram, on places like LinkedIn, on places like Facebook at the Loan Officer Podcast. One clip I loved. My wife was laying in bed the other night, and she was, good news is she's checking it out, right? I thought it was funny as hell, John, like, honestly. And she looks at me and she goes, "Did you just say teat?" Which, by the way, honey, this is my second episode of which I put, I'm saying teat. She goes, "Did you say teat?" I'm like, yeah, like, that's scientific, right?
Correct.
I could have used some other words that are less scientific.
Correct.
And then she goes, "Are you trying to be the next Joe Rogan?"
I hope so.
Yeah, right.
I mean, yeah, that's not bad company. Okay.
Yeah. And then she questioned how interested you were in what I was saying.
I stare and I listen to everything. So much so that people ask me if I'm a loan originator. I'm not, by the way. People ask like, "Oh, JC, shout out to like be a new loan officer." I'm like, no, I'm just a media guy. Yeah. But I can speak and make jokes as if,
Well, a year later, you do. I would tell you this. You know more
than the average bear.
You probably know more than 97% of the American populace when it comes to mortgages.
Crazy.
That's awesome.
It is.
Yeah, like, think about how much of a more well-rounded person you are.
Correct. But I do listen to everything you say. That's why I just look at you and listen. Osmosis. I absorb everything.
And, honey, by the way, I do help pay his salary. Therefore, he's kind of paid to listen to me, right? It kind of comes with the territory.
Right.
No. So let's just jump into this episode, right? Let's just kind of go into it. You asked the question about 2006. That was the last time that we saw this type of, like, oh my God, it's kind of not fun. I feel bad, especially for a first-time home buyer, especially for somebody. We say first-time home buyers because it's assumed a first-time home buyer, a lot of times, they're newer at it. They're not rolling a bunch of equity from their first home purchase into the next home purchase. That means they're probably also short or on the low end of funds for closing. Okay. So maybe they need some help with closing costs. And there's been markets where you could negotiate with the seller to cover your closing cost. If you even try that today, you'd get laughed out of the house. And that makes it not fun. It just does. Plus, a first-time home buyer tends to be buying in the lower price points, the 180 to 250 price point, or if you're in California, the 400 to 450 price point. And those homes are obviously where it's the most competitive. Yeah. All right, so we need to think about and strategize, how can we make our offer stand out? Because, look, you're up against cash offers. It just came out yesterday or 2 days ago that the average of cash purchases, 21%. 21% of purchases, people are using cash.
When you say cash, like they just buy a whole, what is that?
Yeah, cash money, homie. Like, cash. Yeah. They're taking money out of their savings account, out of their investment account. Some people get savvy. Some people may utilize a HELOC. Shout out to an episode we did a couple weeks ago on HELOCs. They may utilize a HELOC where they take money out of one property and then use it to basically, quote unquote, pay cash for the next property. Okay. But yeah, it's a cash buyer. If you're a seller, you love cash buyers, especially a cash buyer who's paying top dollar, because you take a lot of the uncertainty out of the transaction. I mean, a cash buyer, if you're buying a home and you're obtaining financing, you're going to have to show a pre-approval letter. You're going to have to call a mortgage loan originator, and you're going to have to become pre-approved. If you're a cash buyer, you still have to show proof, but usually it's proof of funds. So it's a letter from your accountant, a letter from your financial advisor, or you just send them your bank statement. Like, hey, here's my bank statement.
Okay.
There's enough money there to buy this house, accept my offer. But a cash offer it means there's like no contingencies, right? I'm not having to sell one house to buy this house. A cash offer, I don't need to necessarily get an appraisal, right? If you're financing, your financing is going to be based on a loan to value, which means an appraisal is going to have to come into play. If the home doesn't appraise, it may impact the borrower's or the buyer's ability to qualify, right? So when you introduce cash, I should say, when you introduce cash into a transaction, you take away a lot of uncertainty. So, in today's market, not only is it scarce to have homes that are in move-in condition that you like, right? It's more demand than there is supply. You're also going up against cash. So this episode, let's brainstorm some
Tactics?
Tactics, like the word tactic, yeah. Some tactics that we can use as realtors, as home buyers, and as lenders to make sure our offers are being viewed at the top of the stack.
As you say that, my mind immediately goes to just give them as much money they want and add 10,000. Is that like usually the right answer? Just add money, just throw money at it.
Not really.
Okay.
I mean, yeah, you could do that.
Okay.
You could do that, but then there's always that fear. Well, what if the home doesn't appraise? Is that then going to impact your offer? I mean, it's still an offer. Like I use this all the time when someone's like, I talked to this lender. I'm like, well, who is the lender? Well, I found them online. Like, okay, well, what state are they in? I don't know. And they don't answer my phone calls, and it takes 2 days to call me back. But, look how cheap their quote is. And I'm like, well, a quote's all well and good, but how good is that quote if you never close? So your suggestion, well, shouldn't I just go to the highest offer and add 10 grand? Well, that's a great offer if I'm a seller to accept it, but what good is it if you don't close? Then it's just a piece of paper with a big-ass number on it that means nothing. So I definitely need to go with the offer that's going to close. Now, if you're coming to me and you're like, hey, I'm putting 50% down or I'm paying cash, okay, as a seller, then that's a very strong offer because someone with that much money to put down, even if the home doesn't appraise, they will more than likely still be able to obtain financing for that particular home and still be able to purchase it at the price that they negotiated with me, the seller.
Yeah.
But someone who's only putting 3% or 5% down, or let's say they're a veteran utilizing their VA benefits and they're putting 0% down, that wouldn't work if the home then wouldn't appraise and they didn't have the cash difference to make up between the sales price and the appraised value. So no, that's not necessarily the best way to go, but it could. Like it definitely could, but then you have to ask yourself, are you that guy or that girl who you give 0 Fs and you're just willing to pay or overpay?
No.
Like we all want a fair deal.
Yeah.
Fair. Sometimes good. Sometimes you can't get good.
Yeah.
Sometimes you get a fair deal. Or sometimes you just get a house. Right? What is it that you want? You want a good deal or do you want a home? Because I can get you into a home, but I might not be able to get you into a good deal. But I can promise you this, the deal that you get today, I love the odds of that deal being better than the deal you get next year. Is that home going to be worth more or less in a year?
More.
The odds are always in your favor. It's going to be worth more. Are interest rates going to be higher next year or lower next year?
I would estimate higher.
The odds are in your favor that they're going to be higher. So the deal and the best deal is typically the deal you can get today. But it might not be in your eyes what's called a good deal, but that's okay because you actually decided you wanted a home. You wanted to start creating wealth for you and your family, possibly even generational wealth. You understood you want to do that through buying a home. All right. Anyone who's tuned in, they're like, D.O., just get to the point. I want the tactics. I want the tips. I want the tricks.
Yeah.
Maybe should a disclaimer on this. Fast forward to minute 13 or wherever we are right now.
That's fine.
Can you look over at your little computer? What minute are we on?
I don't know, man.
Oh, you can't tell?
Yeah, it just has, it's in time code. 500 something.
Okay. 500 and something seconds?
Yeah, I don't know.
Okay. We're far along now. People are like, shut up and just get to it. All right. So you get the drift. We want to come up with some tips and some tactics. All right. Let's start with this one.
Okay.
Hey, loan officers, you have a pre-approved borrower who's making an offer on a house. Pick up the phone and call the listing agent. Introduce yourself to the listing agent. Introduce your firm to the listing agent. Let the listing agent know how much work you have done upfront already on your client's pre-approval. Tell them how you have verified income, verified assets. Maybe you've already used Fannie Mae's D1C, Day One Certainty, and you have some income validation already taken care of. That's a great tip and tactic to separate yourself against all the other offers coming in, and the loan officers for those buyers didn't pick up the phone. Pick up the phone and call the listing agent. By the way, listing agents also have buyers, loan officers. Wouldn't you want to build a relationship with another realtor in your marketplace? Of course you would. In fact, when you're doing your pre-approval and you're being introduced to that home buyer for the first time, make sure that you're telling that buyer that this is a service that you provide. Because guess what? You might not be the only lender that buyer talks to or that borrower talks to, but you may be the only lender who has offered or suggested that they would call the seller and or the seller's agent on their behalf to pitch the strength of their financing. That may be the reason why they use you instead of the online lender. They use you instead of the person who's always advertising or the company's always advertising on TV. That's the reason why they may use you and not your bank. So there's my first tip.
Okay.
Call the listing agent.
That matters.
Call the seller.
Yeah.
All right. How about this one? Offer a 10-day financing contingency.
Okay.
Right. So a lot of contracts that I've seen, they have a default, and the default may be 3 weeks. The default may be 30 days. Meaning, if a box is not checked on the sales contract, it means that the buyer has 30 days to obtain a financing,
Yeah.
Right? Meaning, there's a contingency in the contract that states if financing is not available, then the contract is cancelable, and any deposit given will be refunded back to the buyer. Mm-hmm. All right. Well, realtors, are you partnered with a lender who can get you a financing commitment, a loan commitment, conditional commitment within 10 days, 10 business days? All right, 10 business days. Loan officers, if you work for a mortgage company who can't do that, hey, I'm just going to suggest you may want to put your feelers out. You may want to ask yourself, is that worth you looking for another place of employment? It might not be. And I'm not saying that if your mortgage company can't offer a 10-day underwrite a loan approval that you should go leave that mortgage company. Yeah. No. But this is one of the tactics that we're using at the mortgage company that I'm affiliated with. Mm-hmm. We're using this right now in order to help our buyers get their offers accepted. Because, John, I don't know if you know this or not, but do you know how much money we make on having 100 pre-approved buyers?
No, I don't.
Take a wild guess. How much money do you think we make every time we pre-approve someone for financing?
Nothing.
Negative money. We make negative money.
Oh, yeah, you spend money because you have to order reports and stuff.
Yeah. At a minimum, I paid for a credit report, right? I probably ran it through AUS. I probably utilized technology like smart fees. Yeah. We don't make any money as banks and lenders pre-approving buyers. So it does us no good to have 100 pre-approved buyers sitting in our pipeline.
Oh, yeah.
It does us a lot of good when those 100 pre-approved buyers become 100 home buyers under contract and need a financing. So it only behooves us to want to figure out how we can make sure our borrowers, which ends up being a home buyer or a realtor's buyer, that their offers are accepted. Well, how do I make their offer stand out? Me as a lender, I'm going to let my realtors know and the sellers know that, hey, we're going to get you a financing commitment in 10 days. Go ahead and write a 10-day financing contingency.
Is that not the norm?
No, the norm is usually a default of 21 days or 30 days. So I start doing 10. Okay, I'm going to get someone to actually pay attention to my offer. Now, what if I couple that, a 10-day financing contingency and I'm going to call the listing agent. How about a quick appraisal? Are you willing to pay an extra $100 for a rush appraisal? I would be. As a lender, I would be. I'd be willing to pay someone from my appraisal panel an extra $100, $150 to get my order done within a week instead of 2 or 3 weeks, depending on the market you're in. There's some markets that take an appraiser's 3 weeks.
What?
3 weeks to get an appraisal done. So what if I could get my appraisals done in 10 days? Okay. Now by shortening the time period, because if you're a seller, look, time is money. It's all about uncertainty. We discussed, the reason why cash offers are so enticing is because they take away uncertainty. Mm-hmm. A lot of times you never have a financing contingency. You may have an inspection contingency, and rarely would you have an appraisal contingency, right? And contingency is basically, if this doesn't go right, I can back out of the contract.
Right.
It's a buyer telling a seller, these are my outs,
yeah,
to use like one of my poker terminologies that I love to use.
Yeah.
So that again, do I have enough appraisers on my roster? If I don't, I need to work with my appraisal management department to add appraisers so that the more people I have, if I need one done in 10 days, I can send the order out and see, hey, who's willing to do this in 10 days? I may get someone saying, hey, Dustin, I'll do it in 10 days, but not for $550. I need $750.
Okay.
It's a cost of doing business in today's market. I may have to pay, as a lender, that extra $200 to get that appraisal done quickly. And there's a good chance, if I could pass the cost along to my consumer in a compliant manner, that my consumer, my buyer, would understand that, yeah, I paid an extra $200 for my appraisal, but I got the home.
Yeah, I got the home.
I got the home that I wanted.
Yeah.
So that's something else that we can do. Now, depending on where you work, and this is, look, I really try hard not to do like shameless plugs of the mortgage company that I'm affiliated with, but it's just going to show up. Like when you've been somewhere for 13 years, it's kind of A, what you know,
yeah,
and B, there's a reason why I've been here for 13 years.
Right.
I mean, you can't really hide from it. So like here, and I know other mortgage companies have something very similar. Mm-hmm. Like I'm pretty sure my friends who work at Fairway have something very similar. And I know my friends who work at Guild have something very similar. So there, I'm not just pimping out Waterstone, right? Hey, Waterstone. Platinum pre-approvals. You as a media guy,
yeah,
I'm going to teach you about platinum pre-approvals unless you already know.
I've never heard that term.
You've never heard that term?
Platinum pre-approval?
Yeah.
No.
So pre-approval is a very vague term. To be pre-approved, in my eyes, may be something totally different than the eyes of that loan officer at that credit union. Mm-hmm. For me, as a loan officer, I feel like it's my job to be smarter than the underwriters, to be more skilled, more polished, more experienced, and better researched than an underwriter. Mm-hmm. If I tell you, John Coleman, you're pre-approved, then damn it, you're getting a loan.
Yeah.
You are, unless you have a bad inspection, bad appraisal, bad title work, or you do something stupid like quit your job or go buy a car or, not disclose information to me, although I asked you 3 times, do you pay child support? And all 3 times you said no. Yeah. Then I got your pay stub and I'm like, what's this $400 a month garnishment from your pay stub? Yeah, forgot about that.
Oh, yeah.
Yeah. That's happened, obviously. Yeah. Okay. So to me, when I say you're good, you're good. Mm-hmm. But not every loan officer operates that way. I've employed some loan officers who have worked under the Waterstone umbrella that no matter how much we taught and trained them that, they didn't. They didn't collect people's tax returns up front. They didn't double check the bank statements for large deposits. They didn't ask all the right questions. Mm-hmm. Now, those people no longer work at Waterstone. Mm-hmm. We sought them out and helped them explore opportunities outside of the Waterstone umbrella. Yeah. But there's loan officers across the United States, from Spokane, Washington, all the way down to Key West, Florida, that their definition of a pre-approval might not be mine. It's a little bit looser, right? So it's not as ironclad, which means you as a seller could accept someone's offer. And if you only had a 30-day financing contingency written into your contract and not a 10-day, you could be day 28 and realize that your home buyer is being denied.
That happens?
Yes, that happens. Not here at Waterstone, but it happens. It happens. So that's why that whole 10-day financing contingency is a way for us to make our offers more attractive. But it's also why sellers are apprehensive to accept offers with financing. So if you had a platinum pre-approval, and your company, we call it platinum pre-approval where I work.
Okay.
That could be platinum pre-approval. It could be something different somewhere else.
Gotcha.
But essentially, here's what it is. We are taking a file in without a contract. You typically do not send a file to be formally underwritten until you have a contract. Okay. Because so much of the underwriting process is the collateral, the home. The appraisal. Well, if I don't have a contract, how can I have collateral?
Yeah.
I can't underwrite the collateral. But in certain situations where it makes sense, and this market has more of those situations, what if I said, you know what, John, I'm going to go ahead and I want to disclose to you a loan application, right? It's not going to be on a real address, but I'm going to send your file all the way through processing. We're going to order the IRS tax transcripts. We're going to verify your employment with your employer. We're going to go above and beyond and do a complete underwrite. That way, I'm going to have your loan fully approved in underwriting, where that loan approval is without conditions and it doesn't expire for 60 days or 90 days. All I need you to do is go under contract. Once I have an appraisal back and the title work back, we can close you, whether that's 7 days, 10 days, or 14 days. Now, when you're out making an offer, you're making an offer and you are truly competing with cash, because guess what your financing contingency is?
What?
No days.
Right.
You're waiving your financing contingency, which that leads me to another tactic.
Okay.
Realtors and loan officers, you know those super strong home buyers. Like, you know that engineer who's been on his or her job for 17 years, makes 10 grand a month W-2'd and salaried, and their spouse who's been on their job for 22 years and they make their $4,000 a month for the same employer for the past 19 years. You know what?
Yeah.
Okay. And you've seen their bank statement and they have 200 grand sitting in there. You may just want to waive a financing contingency, period, in the story. Like even if one of those two people lost their job, they still qualify, right? Like that may be a tip, trick, or tactic. I'm not a realtor, so please don't take my advice on that. But it's just a side thought that I had. Like, when talking about the platinum pre-approval, like, a reason why you would have it is that you take the financing contingency off the table. Like, we've already done this.
Yeah.
We've already not just pre-approved. We've already approved. Like, I've always argued as a loan officer, I'm so good. My pre-approval is as good as that platinum pre-approval.
Yeah.
But not every loan officer has, completed 1,000 transactions over their 16-year career. They might not have that fortitude and that technical skill set just yet. So they want to feel more comfortable because it's their name on the line, it's their reputation on the line. Let's do a platinum pre-approval. There's a tip or trick or tactic.
So how you package it as a LO matters.
Yeah, well, that's kind of the point of the show. It's like, look, it sucks trying to buy a house right now. How can we help our clients and our realtor partners have their offers looked at in a better light? Right? These are some of the tips, tricks, and tactics that we can use. So let's talk about this.
Okay.
Because we talked about, look, you could waive the appraisal contingency. When and why would you waive the appraisal contingency? Well, if I have a home buyer who's putting 50% down and the home appraises for 5% under contract price, so a $400,000 property appraised for 20 grand low.
Damn.
Okay, if my client was only putting 5% down, I'm SOL. Because I'm assuming the seller doesn't want to budge.
Yeah.
Right? In today's market, a home appraisal is low. I'm assuming the seller doesn't want to budge.
Yeah. Don't care.
Okay, but so in that case, I can't waive the appraisal contingency, because if that home doesn't appraise and my seller can't obtain financing, then I'm going to need something to back out of the contract and something that allows my seller to get his or her deposit back. But if my buyer did I say seller get their money back? I meant buyer, by the way. I'm so sorry if that was interchangeable there. They're not interchangeable. One is buying a home, one's selling a home. So yeah, if that home doesn't appraise, my buyer gets the deposit back.
Gotcha.
But if my buyer, we call them borrowers on the lending side, if they're putting 50% down, whether their loan to value is 50% or 55%, it doesn't really impact the financing. Now, I'm not going to say that a home buyer is going to want to buy a $400,000 home that only appraised for $380,000. But what I'm saying is that if they're putting 50% down, it's not going to impact 99 times out of 100 my ability to finance them. Gotcha. All that it impacts is their loan to value. On my end, their loan to value is now 55% and not a 50%. So those are things to think about as a lender. You have to have those types of conversation with your realtor. Be involved in the offer process and let the realtor know that these are some of your outs. Like, hey, this person is so strong that if the home appraises low, it's not going to impact my ability to offer financing. Now, what if it does? What if in that scenario, the home does appraise low and your client was only putting 5% down? So a $400,000 purchase, it appraised at $380,000. Well, the lender is only going to finance 95% of the appraised value, which is $380,000.
Oh, gotcha.
So, what is that? 38,000, divide that by 2 is 15 plus 2, 16. What is that, John? 19,000.
Math major.
No, it's 19 grand. So now the down payment is 19 grand, but then they have to come up, the buyer has to come up with the difference. That ain't going to work. So what are some ways that we could work around that? So this is what I want to foreshadow to a future class. I would love to bring in one of my mortgage insurance friends to teach a class about how mortgage insurance providers, PMI, how they're utilizing PMI to bridge the gap of when you have a low appraisal, because we're seeing more and more low appraisals in a market like this, right? Supply and demand. The demand is driving up the prices because there's a lack of supply. People are overpaying, willingly overpaying, because they realize that although I'm overpaying by 5%, I'm still getting the home today at today's interest rates, and the home's going to be worth at least 5% more next year.
Yeah.
Right? So what you can do in certain situations is negotiate with the seller. So you're going to have a low appraisal. And again, I don't want to dive into this because this is a whole entire episode in its own.
Okay.
But I teased it enough and I kind of threw it out there that I want people to have a general idea. Because if you're fairly skilled in the mortgage origination arena or the real estate arena, this is going to make sense to you. Mm-hmm. If a home appraises low and your buyer, the borrower, doesn't qualify now because of the low appraisal, and they can't come up with the funds to bridge the gap between appraised value and purchase price, and the seller is like, hell to the no, I'm not dropping the price, or I'm sure as heck not dropping it by 20 grand. Mm-hmm. Well, what are some things that you could do? Okay, well, in the case that I was thinking about, where let's say a home appraised low and now, I don't know, let's say the person was putting down 20%. This is the easiest one.
Okay.
The person was going to put down 20%. Mm-hmm. But for whatever reason, the home appraised low and it appraised low by 20 grand. Well, it doesn't impact the buyer's ability to qualify for financing or for financing to be available. But now, because of the low appraisal and because the borrower only had their 20% to put down, they didn't have 20% plus enough to cover the low appraisal. What if we introduce mortgage insurance? But what if the buyer's like, no, I'm not going to pay over appraised value and now have my monthly payment go up by $90 or $150 a month because of mortgage insurance? Or what if the lender's like, hey, I can still do a loan for you, but once I add the mortgage insurance, your DTI goes up over 45%, and now you no longer qualify.
Jesus.
Well, here's something you can do, guys and girls. You can negotiate with the seller to possibly not drop the sales price by 20 grand, but what if they gave like a $5,000 lender credit or a $4,000, I'm going to say lender credit, seller credit, or a $4,000 lender credit? What is the cost? This is the question. What is the cost to buy out the mortgage insurance? You can do that, by the way. Mortgage insurance does not have to be paid monthly. On a conventional loan, you can do buyer paid one-time mortgage insurance. You just buy it out.
Really?
Yeah, lump sum it. Okay. So in this example of the appraised value came in 20 grand low, now instead of being at an 80% loan to value, because there's going to be a bridge, a gap to bridge, then now the down payment is only going to leave your loan to value at 85%. Instead of putting a $90 or $100 a month mortgage insurance onto the buyer or borrower's loan, at which point, A, they might not want to do because now that makes the home less affordable, and B, they might not qualify because that extra $90 or $100 a month now means that their DTI is over 45 and they don't qualify. Seller already said hell to the no that they're going to drop the sales price, but what if you could get them to meet you somewhere close to the sideline, not even the middle, somewhere close to the sideline? Hey, I'll still pay 20 grand over appraised value, but I need you to kick in $5,000 of a closing cost credit I'm going to use that $5,000 to buy out my mortgage insurance.
Damn, that's some wizardry.
So those are some things, ladies and gentlemen, boys and girls, children 18 plus. Those are some things that you can use in today's market to set yourself apart and make sure your offers are being accepted and being looked at in front of all of the other offers, including cash offers, right? Including a cash offer. And B, if you do find yourself into a sticky situation with a low appraisal, and it's a conventional loan. This really works best on conventional loans. I haven't figured out how I can make it work on FHA, VA, or USDA, but get creative. Get creative with your mortgage insurance. And if you need a better idea of what I mean by that, pick up the phone and call one of your mortgage insurance reps. Mm-hmm. Ask them, because their job is to help you win and close more transactions. Just like loan officers, it's your job to help your realtors win and close more transactions. And loan officers and realtors, you separate yourselves from the competition when you teach and explain to your buyers tips, tricks, and tactics that they can use to make sure that their offer is the offer that wins when you're in a competitive situation.
That was awesome.
That's all I have for you today, John Coleman.
That was great.
Check us out, guys, on Instagram, LinkedIn, Facebook, YouTube, Spotify, Apple Podcasts. If you like what we do, please share us, give us a thumbs up, give us a 5-star review. If you have any comments, commentary, questions, hit us up, whether you email us at theloanofficerpodcast@gmail.com.
Correct.
Or YouTube is a great forum.
Yep.
You can send messages to me directly on LinkedIn. I'm Dustin Owen. You can send messages on Instagram as well as Facebook. But full disclosure, I just got around to replying to a couple messages from like mid-March on Facebook. So LinkedIn's a better forum. The email's a better forum.
Yeah.
I'm Dustin Owen, 407-645-6363. I have been known to pick up the phone if you call.
People have called him, and he's like, hello, and is this Dustin? You sound just like you do on the podcast.
Yeah, it's really me. And I still will take your phone call. But, happy selling, happy hunting. Keep tuning in. And if you have any show suggestions, we'd love to hear from you. But he's John Coleman. I'm Dustin Owen. That's all the time we have today. So, deuces.
Peace.